Hello everyone, I hope you guys are doing good. So this lecture is based on taxes. So we will basically look at why governments actually impose taxes, what are the different implications of that, what is the incidence of tax, how do you calculate that, meaning what is the burden of taxes on consumers and producers, what kind of inefficiency is a result of taxes, and how does the elasticity of supply and demand affects the incidence of tax and also the inefficiency, as well as we will also take a look at whether taxes are fair and which kind of taxes are more fair than others. All right. So the central question of this chapter is, does Congress decide who pays the taxes? So can policies be designed in such a way that we can basically figure out who actually pays the taxes? Is it the producers or is it the buyers? How do we get to know that? So it will depend on a number of different factors which we will be covering in this chapter. So as far as the chapter checklist is concerned, these three are the things that you should be able to do at the end of this chapter. So you should be able to explain how taxes change prices and quantities, and how the tax burden is shared by the buyers and the sellers, and what kind of inefficiency is the result of taxes. We will also take a look at how income taxes and social security taxes change the wage rates and also the employment in the economy. And we will also take a look at what kind of taxes come about as a result of the discussion on fairness of the taxation system. So the first thing that we will take a look at is tax incidence, and it is just a fancy way of looking at what kind of a burden a tax actually places on the buyer and the seller. So when a good is taxed, it has two prices, a price that includes the tax and a price that excludes the tax. So buyers respond to the price that includes the tax because buyers eventually end up paying the tax, and sellers respond to the price that excludes the tax, and that is simply because sellers basically get the price which is after the tax. So they don't get the tax which is paid by the buyers, they get the price net of tax, and the tax is taken away by the government. So the tax is like a wedge between the two prices. So just to give you a clear example about what that simply means is that we'll take an example of an imposition of a $10 tax on smartphones by the government. So let's take a look at a couple of questions over here. How does the price paid by the buyer changes when this $10 tax on smartphones is levied? And how does the price received by the seller changes because of this $10 tax on smartphone? So in other words, we will basically take a look at what kind of burden is put on the seller and on the buyer because of this tax. So as always, it becomes easier to see these kind of economic phenomena when you actually take a look at them graphically, and that is what we will take. That is what we will resort to, even in this case of taxes. So this figure on this slide basically shows what happens when the government taxes buyers of the smartphones. And once again, keep in mind that the tax remains the same. It's a $10 tax on smartphones. So with no tax, the price is $100 and the quantity bought of smartphones is 5,000 units. And you can see that this is the intersection of the blue supply and demand curves. You can see that the equilibrium price over here is $100 and the equilibrium quantity is 5,000 units of smartphones. Now what will happen if a $10 tax on buyers is imposed by the government? So think of this demand curve as measuring the willingness to pay by the consumers. And that is what we have seen in our previous lectures as well, that the demand curve pretty much shows the willingness to pay at each quantity available. So given this willingness to pay on this initial demand curve, after the imposition of the tax, the new demand curve will essentially be D minus the tax. So essentially the demand curve minus 10 would be the new demand curve. And why will this be the case? Because if you think about this, since the consumers will be paying a $10 tax at every price of the smartphone, their actual willingness to pay to the supplier is actually denoted now by this D minus tax demand curve. Another way to intuitively take a look at this situation would be, just imagine that if the government actually imposes a tax on the buyers, it essentially means that the quantity demanded would actually have to go down. And that is essentially what happens over here, because D minus tax curve is actually showing a lower demand at each and every price. And we see this, that the initial demand curve is above the final demand curve, and the final demand curve D minus tax is actually 10 below the initial demand curve at each and every initial point on the initial demand curve. So after this shift of the demand curve, the buyer's price rises to 105, and that is simply because the buyer will actually pay what is above this new equilibrium on the initial demand curve. So it's basically an increase of $5 from the initial equilibrium price of $100. The seller's price falls to $95. So this new equilibrium will actually be corresponding to the price that the seller is receiving. So there is an important distinction over here, because the seller is actually receiving this $95, and this is what the consumer is willing to pay to the seller. But the consumer actually also has to pay this $10 over here, because that actually goes to the government whenever a purchase of the smartphone is made. So you can easily see over here that the quantity, the equilibrium quantity, actually decreases from 5,000 units to 2,000 units, and that actually makes intuitive sense, because whenever a tax is imposed, things becomes expensive, and that's why the quantity demanded, or the equilibrium quantity of that product, will actually decrease. The government tax revenue is $20,000. How do we calculate that? It's simply the area of this rectangle. So you can see that 105 minus 95 is 10, and this side measures to 2,000 units. So 2,000 multiplied by 10 gives us a total shaded region area of $20,000, and that is the government's tax revenue. The important thing to note over here is how much of the burden actually falls on the buyer and how much of the burden actually falls on the seller. So think about this. This was the initial price of $100, and now the price that the seller receives is $95. So $5 of the total $10 tax burden falls on the seller, while you can see that the buyer now actually pays the price of 105 rather than the initial equilibrium price of $100 per unit of smartphone, which means that $5 of the $10 burden, of the total $10 burden of the tax also falls on the buyer. So essentially it means that the burden of tax on buyers and sellers in this case is equal. So both are sharing the same burden, which is a burden of $5 each out of a total of $10 of tax. Now obviously the burden can change because of different factors, and we will take a look at those factors in some of the later slides in this lecture. Alright, so let's change the situation a little bit. So right now in this figure we will actually change the situation, and we will impose the tax on the sellers, the same tax of $10 per unit of smartphone on the sellers rather than the buyers like in the previous example. So once again, we basically show this example graphically because it just makes it easy to imagine what is happening. So without any tax, this point over here shows the equilibrium without any taxes. So if there was no taxes, the equilibrium price would be $100 for the smartphone, and the equilibrium quantity would be 5,000 smartphones per week. Now if a $10 tax on sellers is actually imposed, what will happen to the supply curve? Well, first of all, let's think of what will happen to the demand curve. Now if the tax is imposed on the suppliers, it would simply mean that there will be no change in demand. But obviously if the tax is imposed on the sellers, the supply curve should shift. Now how will it shift? So the new supply curve will actually be above the initial supply curve. And how above will it be from the initial supply curve? It will be basically above $10 above every point on the initial supply curve. Now why is this the case? So think about what the supply curve actually means. So the supply curve actually means or shows the willingness to accept. So what price are the sellers willing to accept in order to sell their smartphones? So if this initial blue supply curve is showing the willingness to accept or the price at which the suppliers are willing to sell their smartphones, imagine a situation in which for every smartphone sold, now the suppliers have to pay a $10 tax to the government. So it would simply mean that their true willingness to accept would actually be $10 above this initial supply curve. So that's why we move to this new supply curve, which can be called S plus tax, and that is simply because it is parallel to the initial supply curve, but the difference from every point on the initial supply curve is a difference of $10. Alright, so given this shift of the supply curve because of the tax, the buyer's price rises to $105, an increase of $5 a smartphone. So what is the buyer's price? So buyer's price once again is this this new equilibrium. So this is what the buyers actually pay for this for the smartphones in this market after the imposition of the tax. But what do the sellers actually receive? So sellers only receive $95 per smartphone, and that is simply because for every smartphone sold, $10 is actually taken away by the government. So if that is the scenario, $105 is paid by the buyers while $95 is received by the suppliers. So the quantity decreases to 2,000 smartphones a week, and that makes intuitive sense because the initial equilibrium showed the quantity of 5,000 smartphones per week, and it has dropped down to 2,000 smartphones per week simply because imposition of taxes makes everything expensive. So the final quantity sold and bought for smartphones should technically decrease. So the government's tax revenue is a total of $20,000, and once again this is the area of this shaded region. That is the total revenue or tax revenue collected by the government, and you can see that 105 minus 95 is 10, while this side over here is equal to 2000 units of smartphones. So 2000 multiplied by 10 becomes $20,000. So once again, what we are interested in is how much tax incidence falls on the buyers and how much tax incidence or the tax burden falls on the sellers. So initially, when we were at this equilibrium, the buyers were paying $100 and the sellers were receiving $100. Now the buyers are paying $105, so $5 of the total $10 tax burden is basically falling on the buyers. On the other hand, sellers are now receiving $95 rather than $100 as what the previous or the initial equilibrium dictated. So it means that $5 of the total $10 tax burden is also falling on the sellers. So once again, the burden on the buyer and the seller is equal, and it's equal to $5 each. So you can see from these two initial examples that it really does not matter whether the tax is imposed on the seller or on the buyer. Sometimes the burden will actually remain the same on the sellers and the buyers, as shown by these two examples. So next we will take a look at the relationship between taxes and efficiency. So as the previous figures suggest, after the imposition of the tax, there's a loss of efficiency in the market, and some sort of inefficiency results. We will take a look at that in greater detail now. So the equilibrium quantity is less than the efficient quantity, and a deadweight loss arises because of taxes. So let's see how that happens. So this figure over here on the right shows us the market of smartphones without any tax. So you can simply see that the consumer surplus over here, shown by this triangle area, and the producer surplus over here, shown by this triangle area, is actually maximized in this situation. So it means that everyone is happy at this equilibrium. Consumer surplus is maximized, producer surplus is maximized. So the total surplus is the exact sum of the consumer and the producer surplus. So how will the situation change after the imposition of the tax on suppliers? So when the tax is imposed on suppliers, the supply curve shifts upward to supply plus tax. So from every point on the initial supply curve, the supply curve moves by the amount of the tax, as shown by the previous example as well. So a $10 tax shifts the supply curve to the initial supply plus $10. So at this new equilibrium, the marginal benefit exceeds the marginal cost, and the consumer surplus shrinks and the producer surplus also shrinks. How do they shrink? So right now, after the imposition of tax, only 2,000 units of smartphones are being demanded and supplied, rather than the 5,000 units which were demanded and supplied previously. So because of this change, only the consumer surplus up to 2,000 units of smartphones can be extracted by consumers, which means that the consumer surplus actually shrinks to this small triangle over here. But while previously the consumer surplus could have been extracted up to this point of 5,000 smartphones or 5,000 units of smartphones. The case is similar when we take a look at the producer surplus. The producer surplus is also shrinking because only the producer surplus up to 2,000 units of smartphones can be extracted by the suppliers in this market, while previously the producer surplus was extracted up to this initial equilibrium quantity of 5,000 units of smartphones. So you can simply see very clearly over here that the consumer surplus and the producer surplus will shrink after the imposition of the tax. Now, where is all this extra surplus or the surplus which was previously part of either the consumer or the producer surplus actually going to? So as we highlighted earlier when we were taking a look at the tax on suppliers, this rectangle area over here, which corresponds to 20,000 tax revenue collected by the government, shows that this portion of the total surplus actually goes in the form of tax revenue to the government. Now, a deadweight loss also arises because of the imposition of tax, and that deadweight loss is actually this triangle region, which was previously part of either the consumer surplus or the producer surplus. Now this deadweight loss actually shows a loss of resources. So the loss of consumer surplus and producer surplus is the cost of the tax. So in other words, the cost of the tax is the total tax revenue generated plus the deadweight loss. So deadweight loss, or the excess burden of the tax, can obviously be calculated if you have the if you are presented with the numbers. In this case you are, so you can simply use the half multiplied by base multiplied by height formula to calculate the area of this triangle. So the base is equal to 10, the height is equal to 5 minus 2, which is 3,000, and you can divide the 3,000 multiplied by 10 by 2, and when you do that, you get the total excess burden or the deadweight loss equal to $15,000. So remember, total cost of the tax minus the tax revenue generated by the government gives us the deadweight loss. Alright, so far we have taken a look at how things change in the market whenever a tax is imposed, and we have also taken a look at the incidence of the tax, meaning how much the burden is imposed on the seller and how much of the burden is imposed on the buyer. We have also established that inefficiency is a byproduct of the imposition of taxes, because some of the total surplus goes to the government in the form of tax revenues, and some of the total surplus also becomes the excess burden or the deadweight loss. So now we will actually try to combine these three concepts, and we will also combine the concept of elasticity, and we'll take a look at how elasticity actually affects the inefficiency which is caused by in the market, and also the incidence of the tax. So what we will basically see in the following slides is that for a given elasticity of supply, the buyer pays a larger share of the tax the more inelastic is the demand for the good. So if the demand for the good is more inelastic, it would mean that the buyer will pay a larger share of the tax. On the other hand, if the supply of the good is more inelastic, the seller will pay a larger share of the tax. And the more inelastic the demand or the supply, the smaller is the excess burden, which means that the more inelastic the demand or the supply, the smaller is the deadweight loss. So let's take a look at how these actually work out in practical examples by using the help of graphs. Alright, so what we will take a look at initially is that we will be dealing with the elasticity of demand. So we will take a look at two extreme cases. One case will be of perfectly inelastic demand, where buyer pays all the tax, and it is a case in which there is no loss of efficiency. The second case would be the case of perfectly elastic demand, in which the seller pays all the tax, meaning all the burden of the tax falls on the seller, and it also results in inefficiency, which means there is some sort of a deadweight loss. So first we will take a look at the case of perfectly inelastic demand. So let's suppose you are looking at the market for insulin. So market for insulin, first of all, will have a perfectly inelastic demand, because insulin is basically like whoever requires insulin no matter what the price of the insulin is. So if a tax of 20 cents a dose is imposed in the market for insulin, it will raise the price paid by the buyers by 20 cents. So you can take a look at it in the sense that since this is a sort of a necessity good for people who actually need it, it won't really matter if some sort of a tax is imposed. The same quantity will be bought by the buyers. So given this vertical demand curve showing perfectly inelastic demand for insulin, what will happen is that the supply curve will actually move up by the amount of the tax, and the whole tax will actually be paid by the buyer. So the whole burden, the total burden of this 20 cent tax will actually be on the buyers, and there will be no burden on the sellers. The other thing which you have to take into account in this case is that the marginal benefit equals the marginal cost. So the outcome is efficient. So you don't see the existence of that triangle which was showing the area of the deadweight loss in the previous examples. So that triangle is nowhere to be seen over here, which ultimately means that there is no deadweight loss in the case of a perfectly inelastic demand. So if there is no deadweight loss, it means that there is no loss of efficiency, and marginal benefit equals marginal cost, even after the imposition of tax. Now let's see how things change when we take a look at the case of perfectly elastic demand. So this is the case of a market for pink pens. So why will the market for pink pens have an elastic demand? It simply means that it really does not add much value if you are using pink pens or black pens or green pens. So what this horizontal demand curve is showing is that if the price of the pink pens increases even by a little bit, the demand for pink pens will fall to zero. And why will that be the case? It will simply be because people can switch to red pens or green pens or black pens or any other colored pens if the price of the pink pens actually increases even by a little bit, even marginally. So if a tax of 10 cents is imposed on the seller in this market, what will happen is that first of all, the supply curve will actually move up by the amount of the tax, which in this case is 10 cents. And when that happens, the seller will be actually totally getting the brunt of the tax, meaning all of the burden of the tax will actually fall on the seller. And you can see that the equilibrium quantity decreases from 4,000 pink pence to 1,000 pink pence after the imposition of this tax. But the important things to remember are two over here. The first one is that all of the burden actually falls on the seller, and that makes intuitive sense because think about this for a second. Is the seller in a position to pass on some of the burden to the consumer? No, it simply means that even if a 1 cent of the burden is passed on to the consumer or the buyer will actually switch to any other pen in the market, and they will not buy any pink pen. So it simply means that the supplier or the seller is in no position to actually pass on any of the burden of the tax on to the buyer. So the seller basically takes the brunt of the total tax, and you also see this triangle area appearing over here, which means that there is a deadweight loss over here. So there is some sort of an excess burden of this tax, which is the deadweight loss, and the outcome is not an efficient outcome, it is an inefficient outcome. So now we will take a look at the cases of perfectly inelastic supply and perfectly elastic supply. So in the case of perfectly inelastic supply, the seller gets the brunt of the tax, meaning there is no burden on the buyer and the outcome is efficient, while in the case of perfectly elastic supply, the buyer gets the brunt of the tax, meaning there is no burden on the seller while the outcome is inefficient. Let's take a look at these two examples. So the first example is of a perfectly inelastic supply, for example, the market for spring water. So first of all, let's take a look at or think about why the market for spring water will have a perfectly inelastic supply. So it will simply be because spring water can only be supplied up to a certain quantity in a week, and that basically depends on how much water actually comes out of the spring every week. So if 1,000 or 100,000 bottles can be bottled from the spring every week, it would mean that the supply is pretty much inelastic because it cannot change no matter what the price of the bottle is. So it really does not matter how much the price of the bottle is. If it's 45 or 50, you will only the supplier can supply the number of bottles which can be bottled from the spring water in a given time period, and there's a limit to that. So when that happens, suppose a tax of 5 cents a bottle is actually imposed by the government. So if that is the case, and there is a tax imposed on the seller, so the seller will pay the entire tax. So whenever there is a tax on the seller imposed, the supply curve actually moves upwards to S plus tax. But since this supply curve is already a vertical supply curve, a perfectly inelastic supply curve, you can think of it as the supply curve moves on top of itself. So that is the way I would describe it. But when that happens, you can also imagine, when that happens, the total burden of the tax is actually on the seller, and the intuitive way of looking at this or describing or explaining this sort of a phenomena would be like, in response to the tax or the imposition of the tax, can the seller actually reduce the supply? No, it cannot, because when you are bottling water from a spring, the spring water will come out no matter what, so you will still bottle the spring water. So the supply cannot change, and that is shown by the perfectly inelastic supply, and when that is the case, all of the burden will fall on the seller. And another important thing to note over here is that triangle area of excess burden or the deadweight loss does not appear over here, and that is simply because the marginal benefit equals the marginal cost in the situation, and the outcome is an efficient outcome. So now we'll take a look at the case of perfectly elastic supply in the market for sand. So first of all, why is the supply perfectly elastic in the market for sand? It's simply because sand is freely available. It really does not matter how much sand can be supplied. So think of sand. Sand is freely available. So the quantity of sand supplied, really there's no limit to that. So at every possible point, any amount of sand can be supplied. That is what a perfectly elastic supply curve essentially means. So when that is the case and a tax on the seller is imposed, so obviously you will see that the supply curve will move up by the amount of the tax, and in this scenario all of the burden of the tax will be passed on to the buyer. Also, you will see that a triangle area of the deadweight loss also appears over here. So two things are happening in this case, two important things. So first one is that the total burden of the tax will be passed on to the buyer, and also this efficient is not an efficient outcome, it is an inefficient outcome shown by the presence of the excess burden or the deadweight loss. So there are three different kinds of taxes that we will take a look at in this lecture. There are personal income taxes, corporate income taxes, and social security taxes. So together these three actually raise 3/4 of the total government tax revenue in the US. So Congress is the one who sets these tax rates of all three of these taxes, but who actually pays the tax, meaning what is the tax incidence, meaning the burden on the seller or the buyer. Let's take a look at that. So first we will take a look at the income tax, tax on labor income. So the important points to recognize now that you have the mechanics of how the elasticity of supply and demand actually affects the incidence. Now, what we can do is that we can think about whether the labor demand or labor supply is more elastic than the other. So whichever is more inelastic, it would mean that the burden will actually fall on that end of the stick. So let's take a look at the labor demand first. So think of labor demand as firms demanding workers' labor. Now, if firms are using workers as one of the factors of production, can they actually get away from using workers as one of the factors of production? Well, they can up to a certain level, meaning they can definitely substitute at least some workers for machines, which actually makes the labor demand highly elastic, because in today's world, when a lot of technological progress has already taken place, a lot of machines can actually replace workers, and that is what is actually happening with the robotics and the mechanization, and that is why the labor demand is becoming more and more elastic. Now take a look at the other end of the spectrum, the labor supply. Now most people have to work in order to get a living wage or in order to earn their income. So the supply of labor is actually highly inelastic, because most people, in order to just survive, in order to get by, in order to buy food, in order to afford housing, have to supply their labor. So no matter what the wage rate is, there will still be people supplying labor, which makes the supply of labor highly inelastic. So with the elastic demand and inelastic supply, the worker bears the greater burden of the income tax. So remember, from the previous examples, whenever whichever of the supply or demand is more inelastic, that party actually bears the greater burden of the income tax. So let's take a look at that with the help of a graphical example. So this initial equilibrium is the equilibrium without any sort of tax on income or any sort of tax on labor income. So LS means the labor supply, LD means the labor demand. So without any tax, the wage rate in the market is $19 per hour, while the equilibrium quantity is $40 is 40 hours per week. So now let's suppose that the government actually imposes a 20% marginal tax rate on labor income or labor supply, which would actually shift the labor supply curve up by a margin of 20% from the initial labor supply curve. So when that happens, when this upward movement of the labor supply curve actually happens, we get to this new equilibrium. And at this new equilibrium, the wage paid by the employer actually rises from $19 to $20. But the wage rate actually received by the worker falls from $19 to $16. So it's clearly shown by this example over here that the employer pays some part of the tax, meaning the 20 minus 19 in this case is paid by the employer, while the worker pays the huge or the major chunk of the tax. So 19 minus 16 in this case is the portion of the tax which is paid by the worker. So as it was pointed out earlier, since the labor supply is more inelastic than labor demand, the worker will actually bear the greater brunt of the income tax, and that is what we can see from the graph as well. You can also see that a deadweight loss arises, this triangle area, which is basically showing a loss of total surplus from the consumer and producer surplus. Now we can also take a look at the example of tax on capital income. Now how is this different from tax on labor income? So taxing the income from capital works is different in the sense that capital is internationally mobile, which means that the supply of capital is highly elastic. So remember that the supply of labor was highly inelastic, but the supply of capital is highly elastic. It can even be perfectly elastic. So we will actually stick to assuming that it is perfectly elastic, shown by this horizontal supply curve. So this is the supply of labor, this is the supply, this is the demand of labor, KD is the demand for labor, KS is the supply for labor. So if this is the initial equilibrium, which is shown by the intersection of the supply of capital and the demand of capital, now from this situation, from this initial point, there is a 40% tax on capital income imposed by the government. If that is the case, the supply of capital curve will actually move upwards by a margin of 40% from every point on the initial supply curve. If that is the case, we can see that the firms will actually have to pay the entire tax. So in this scenario, the firms who are actually demanding the capital will actually have to pay the whole, will actually have to bear the total burden of the tax. And you can also compare this when you are, you can show why this is happening by comparing the elasticity of demand of capital and the elasticity of supply of capital. You can see over here that the elasticity of demand of capital is more inelastic than the elasticity of supply of capital. So remember, whichever is more inelastic shares the greater burden of the tax. And in this case, the firms are the ones who are demanding the capital, which is the more inelastic of the two between demand and supply. So that's why firms will pay the entire tax. And it also shows that a huge deadweight loss will also result. So this is definitely not the case of an efficient outcome. So remember that if you know the mechanics of the elasticity, that how the elasticity will affect the incidence, and the easiest way to remember is that, whichever is the more inelastic from the supply or the demand, that side of the market will actually face the greater burden of the tax. So the next form of tax that we will take a look at is a tax on income from land and other unique resources. So works in the same way as the tax on capital and the tax on labor income. The only difference once again would be like whether it is more inelastic or whether the supply of land is more elastic. And if you just think about it intuitively, you can think of the supply of land as highly inelastic, because obviously you cannot change the supply of land by a lot, which means that no matter what the price of land is, it's pretty much remains the same, meaning it is highly inelastic. So you can pretty much imagine what will happen in the case of a tax in this market, because the tax on land income is paid by the landowners and the quantity of land pretty much remains unaffected by the tax, which means that the total burden of the tax falls on the landowners. We will take a look at this graphically in this slide. So supply of land is perfectly inelastic, shown by this vertical supply curve. If that is the case, all of the tax, let's suppose that the tax which is imposed in this market is 40%. So it would mean that this whole 40% of the tax will actually be on the landowners, on the suppliers of land. So is there any deadweight loss or existence of excess burden? No, because you cannot see that triangle appearing on this graph, which means that there is no deadweight loss, which means that the marginal cost is equal to marginal benefit, showing that the market is still an efficient market, the outcome is still an efficient outcome. Now let's take a unique example. We'll basically take a look at the supply of Bradley Cooper's services and the demand for Bradley Cooper's services. So Bradley Cooper is known to making only 3 movies a year, which means that the supply of Bradley Cooper's services is a perfectly inelastic supply curve. It always remains at 3. So no matter what the price is, Bradley Cooper only supplies 3 movies a year. If that is the case, and a 40% tax is actually imposed in this market, Bradley Cooper, because the supply of Bradley Cooper's services is perfectly inelastic, it would mean that the burden of this tax will purely fall on Bradley Cooper. So the entire burden of the tax will be passed on to Bradley Cooper, as shown by this margin over here. But in this scenario, since the supply curve is perfectly inelastic, it results in no deadweight loss, so it's still an efficient outcome after the tax. Now the Social Security tax basically pretty much follows the same sort of logic as the tax on labor and the tax on capital. What we need to look at is whether the labor supply is more inelastic or elastic than the labor demand, and we have already figured out from the previous example of tax on labor income that labor supply is more inelastic than labor demand. So if that is the case, and and a social security tax of $2.50 per hour is actually imposed, what will actually happen in this market? So what will happen is that we will get to this point from the initial equilibrium point because of the imposition of tax. So first of all, what we need to realize is that the workers hired will actually decrease from 4,000 workers to 3,000 workers, and the wage paid by the employers will actually go up from $12 to $12.5 an hour. But the wage received by the workers will actually fall from 12 to actually $10 an hour. So you can easily see that the burden on the worker who is supplying the labor is $2, 12 minus 10, and the burden on the employer who is hiring or demanding the labor is 12.5 minus 12, only 50 cents. So the total burden of the $2.50 tax per hour falls more on the worker, which is supplying the labor, than the employers, and that is simply because the labor supply is more inelastic than the labor demand. Although the purpose of the social security tax by the government was that the workers and the employers will actually share the burden of this tax equally. But this is a classic case, an example of whatever the Congress decides cannot really happen, because even the taxes will follow the market patterns, meaning the taxes will also be impacted by the elasticities of supply and demand. So no matter how hard the congressmen or the policymakers or the politicians try to make sure that the share of the tax is equal on the workers and the employers, it really won't have any impact unless somehow the elasticities of demand of labor and supply of labor actually changes, which once again cannot be done. So given these situations, the greater burden of the social security tax falls on the workers, while the smaller burden falls on the employers. So finally, in this lecture, we will take a look at the issue of fairness. So whenever politicians or political leaders or policymakers are actually debating tax issues, the issue which is at the forefront of discussions is usually not efficiency, but fairness. How will the burden affect the different segments of the population? So there are two conflicting principles of fairness of taxes. The first one is the benefits principle. The second one is the ability to pay principle. So the first one, the benefits principle, basically just means that people should pay taxes equal to the benefits they receive from public goods and services. So think of an example of a road, a government road, which charges a toll for users. So the more you use that road, the more toll you will have to pay, and the less you use it, the less toll you will have to pay. So it basically follows the benefits principle, in the sense that the more benefit you are extracting from that government resource, that government public service or good, the higher the tax you should be paying. So this is just one example of government taxes in which the benefits principle can be imposed, but in most examples of public goods, the benefits principle can probably not be easily imposed. For example, you cannot really charge people for public parks as for the amount of park service that they use. Similarly, it would be very hard to do it for public libraries. So benefits principle is a good principle to have, because it will actually exactly charge people for how much service that they are actually extracting from that good, or how much benefit they are extracting from that good, but it is usually hard to impose. The second principle is the ability to pay principle, and there is the proposition that people should pay taxes according to how easily they can bear the burden. So that comes back to the classic debates of are rich people paying lesser tax than the poorer people. So this concept of ability to pay principle basically says that since the rich people can more easily bear the burden of providing public goods, they should pay more than poorer people, than poorer households. And this ability to pay principle has two components. The first one is the horizontal equity. The second one is the vertical equity. So horizontal equity is the requirement that taxpayers with the same ability to pay should pay the same taxes. While on the other hand, the vertical equity deals with the idea that the taxpayers with a greater ability to pay should bear a greater share of the taxes. So when we combine both of these concepts, horizontal and vertical equity, we can actually impose the ability to pay principle, and there is a more common way of allocating or deciding who actually pays the tax. Ability to pay principle is a way more popular way of deciding or imposing taxes. So the relationship between tax rates and income levels depends on the degree of tax progressivity. And to describe tax progressivity, we use two tax rates: the average tax rate, which is the percentage of income paid in tax, and the marginal tax, which is the percentage of an additional dollar of income paid in tax. So when the tax is a progressive tax, the marginal tax rate exceeds the average tax rate. So what does that mean in simple layman's term? So take the example of a progressive tax rate system. So for example, if someone's income is $60,000, and for the first $50,000 of income you pay a tax rate of $10, and for the next $10,000 of income you pay a tax rate of $15. Or you pay a tax rate of 15% on the next $10,000. So the overall tax rate for this person who is actually earning an income of $60,000 would be somewhere between 10 and 15%. But the marginal tax rate, which is the tax rate on an additional dollar, will be equal to 15%. So what it means is that in this scenario, the marginal tax rate, 15%, will be higher than the average tax rate, which will be somewhere between 10 and 15%. And in that scenario, if that is the case, that is a clear indicator that this tax system would be an example of a progressive tax system. So the taxes can be progressive, they can also be proportional or regressive. What it simply means is that if a tax is a progressive tax, the average rate increases as income increases. If it's a proportional tax, the average rate remains the same at all income levels. And if it is a regressive tax, the average rate decreases as income increases. So there's usually a lot of debate about what taxes are regressive taxes. An example of a regressive tax is a sales tax, because if I buy a bottle of shampoo, my income is lesser than, and if my income is 60,000, for example, and if a millionaire buys the same bottle of shampoo, since their income is larger, it would mean that their tax on that, the tax paid on that bottle of shampoo is a smaller percentage of their income than the tax that I am paying on that same bottle of shampoo, because the denominator, the income, in my case is way lower than the case of a millionaire. So sales taxes are an example of regressive tax, while on the other hand, income taxes are an example of progressive tax, because the higher your income becomes, your marginal tax rate actually increases by a lot. So what is the big trade-off? So the big trade-off that policymakers or politicians always face is the trade-off between efficiency and fairness. So obviously, whenever policymakers are deciding about which tax to impose, they have the concern of efficiency and also the concern of fairness. And more often than not, the concern of fairness wins over the concern of efficiency. So take the example of the tax on capital. So as shown by the graph earlier in this lecture, the tax on capital incomes creates the greatest deadweight loss, and that is simply because the supply of capital is elastic, is perfectly elastic or close to being perfectly elastic. And when that is the case, all of the burden falls on the firms which are demanding the capital. So on the surface, it seems that it would be not be an ideal situation because of the great deadweight loss which occurs, but since most of the capital is owned by or demanded by a small number of rich people, most of the people believe that taxes on capital are actually very fair, because once again, the burden is actually falling on the richer segment of the population. So once again, so in this kind of a scenario, the concern of fairness actually wins over the concern of efficiency. So, but you have to keep in mind that whenever any sort of tax is being discussed or is being imposed, the two concerns are efficiency and fairness, and policymakers always have to juggle with these two goals. So this was the lecture on taxes. I hope you guys had a good time listening to this lecture, and you guys actually learned about how taxes are actually imposed and what are the different consequences of those, and the incidence and all of the stuff which is related to taxes. So thank you for watching, and take care.